This week, we're thinking about the disclosures that firms are both required to make and also those that they choose to make. It is important for us to consider these disclosures as it helps us determine the extent to which current financial statement performance is likely to continue. The accounting rules typically require firms to provide additional information when they lodge their financial statements. These include the notes to the financial statements, which provide details on specific items found in the main financial statements. For example, firms are required to disclose information about their different operating segments so that users of the financial statements are in a better position to evaluate how different parts of a business are performing. BHP discloses results by petroleum, copper, iron ore and coal. JB Hi-Fi reports information for the following segments: JB Hi-Fi Australia, JB Hi-Fi New Zealand and The Good Guys. Other disclosures include information about executive pay as well as general discussion of their results, which is typically found in the Management Discussion and Analysis section of the annual report. Some disclosures are required by the relevant corporations legislation, and others are required by stock exchange listing rules. In Australia, the stock exchange requires listed firms to immediately disclose to the market any information that would likely affect the share price. This is part of what's known as the continuous disclosure regime. Anything required by the rules or regulations is what we call mandatory disclosure. Of course, organisations can choose to provide more information than the minimum required. This is typically called voluntary disclosure. Firms will often provide additional disclosures to compensate for limitations in the mandatory accounting rules. Many managers believe that the accounting rules do not allow them to do a good job of communicating the underlying economic performance of their businesses. Non-GAAP or pro forma earnings have been increasing in their frequency over time. These are performance measures that are not produced in accordance with the accounting rules. The adjustments made in non-GAAP earnings are not always income increasing. In my research on the use of non-GAAP earnings in Australia, we found that pro forma figure was higher than the corresponding GAAP metric only about 60% of the time, which is much lower level than we were expecting. Other researchers found that, on average, non-GAAP earnings are informative rather than misleading from an investor perspective. That is, the stock returns for a company correspond more closely to the non-GAAP earnings than the GAAP earnings. Managers often include an articulation of the company's long-term strategy, a specification of non-financial leading indicators that are useful in judging the effectiveness of the strategy implementation, and forecasts of future performance. There has been much recent interest in the ESG information that firms provide, especially that relating to sustainability or climate-related information, and it seems that this trend is likely to continue. One of the issues that we highlight in the unit is the difficulty that firms have in determining which metrics to measure and which rules to follow. Hopefully, we will continue to see consolidation in the number of bodies putting out rules on the disclosure of sustainability-related issues. Voluntary disclosure can also include forward-looking statements about either financial or non-financial measures. This would include things like managers providing earnings forecasts. These are often called earnings guidance. However, there has been a pushback against the incentives that quarterly earnings guidance and quarterly reporting have on management. It's often claimed that it forces managers to focus too much on the short term at the expense of long-term value creation. You'll see an additional video addressing some of these issues that researchers investigated. Firms are often willing to provide additional information. If investors don't have the same information set as management, they will probably find it difficult to value new and innovative investments. If investors are uncertain about the future prospects of a firm, it's rational for them to take a conservative view, which would lead to a firm being undervalued. One constraint in providing more information is the competitive dynamic in product markets. Disclosure of proprietary information on strategies and their expected economic consequences may hurt the firm's competitive position. Managers then face a trade-off between providing information that is useful to investors in assessing the firm's economic performance and withholding information to maximize the firm's product market advantage. Your role as an analyst is to assess the information that the firm provides and how well it helps explain the existing strategy. Keep in mind that you'll be wanting to use all of this sorts of information to assist you when you are coming up with your forecast of future financial performance.